we talked about roll yield, if you remember.
Yes, yes, yes.
Then I explained you the concept of contango.
Yeah,
And then I also explained the concept of backwardation.
yeah,
And I said, let's just remember backwardation for good, because in backwardation, we can really relate that if some negative news is there,
yeah.
so my VIX future prices will immediately be higher at this point, right?
Correct.
And then lastly, we discussed that in such a scenario where you have a backwardation, think about that you are buying something at here and you need to roll on. So you need to buy something over here. So the next time you will buy it cheaper. So if you are long a backwardation situation, then you will make money or you will make profit. Right?
Yeah.
And I think I also
Can you explain how you would make money, like for backwardation, like just one trade? Can we just do
Oh,
it?
okay. So make money as in you will save money more. So the example that I gave you, that if you want to buy 1 kg of apple and it is
Yes,
costing you
yeah,
100 kgs, and while
got it.
rolling over next time, if it costs you 50 rupees per kg, then you are saving 50 rupees. It means you are making the money, you are making a profit in rolling over.
Yep.
And then I also we discussed towards the end that you can also have swap, and I was laughing about it that they actually did everything whatever they could, right? So they
Yeah.
even
Variance
created
swap.
a product as variance swap,
Yeah.
where I mentioned that obviously there will be two counterparties, counterparty 1 and counterparty 2.
Correct.
In this case, somebody who is long the variance swap would be the one who would, and let me just quickly write the formula so that we would know.
Yeah.
And I said that there is something called as realized volatility,
Mm-hmm.
and something is implied volatility,
Yeah.
right? Yeah. And I said this implied volatility is something that we assume immediately, right, at the initiation of the contract, and then the realized volatility is something that we are only get to know at the end of the contract.
Yes.
And then I said I'm calling this as A and this as B, and I said if A is more than B, then the buyer of the swap, right, makes profit. And
Yep.
then most likely you asked me that what could be the scenario that the buyer of the swap makes profit, and I said think about 2025, where people will think that a lot can happen towards the year, right? While at the starting of the year the volatility is, let's say, just 2%. So the implied volatility assumption, looking at historical data, so you can say okay, it could be little more than 2%, so could be 3%. But somebody who is a buyer of the contract could believe that the volatility could be too high, so the realized volatility at the end of 6 months could be, let's say, 8%.
Mm-hmm.
Right? So buyer of a variance swap would get into a contract where this realized volatility is unknown at the starting.
And the
And
realized volatility is over what period?
for the period of the contract.
Got it.
Whatever
Got
it
it.
could be. It could be 3 months, it could be 1 month, or
Makes
whatever.
sense. Makes
Right?
sense.
And lastly, I now remember, while I was closing the session, I said that the standard way of calculating the volatility is x minus x bar square by n minus
Yeah.
1, while in this case we do a x upon n minus 1.
Correct.
Right? Okay. Now, and I said when I'm going to start the next class, we're going to start with some formula, right? So I'm now extending my discussion in terms of what we discussed. So can I say that the profit or maybe loss, whatever that I'm going to make, depending on if I'm long or short, can be equal to the notional principal on the variance, obviously, multiply the difference between sigma square minus k square, where this is your, we call that as a strike volatility.
Mm-hmm. Yeah.
Or maybe we call it as a implied volatility, we just discussed.
Yeah.
And we call this as a realized volatility. So a lot of times sometimes this name is a little confusing because the word realize means that it has already been realized. But then the idea is that the profit or loss is being given by this is at t equal to 0 and this is t equal to t. So since I'm calculating my profit or loss at this point in time, so on that day, what will be the realized volatility is being given by this. Obviously, at t equal to 0, this sigma square is unknown.
Yeah.
Make sense?
Yeah.
So this is called as you. Although I gave you the nomenclature, which is something that you can understand from your previous discussions, but this effectively is called as N var. Nothing different. It is the same thing, but
Which
it is
one?
a representative. This NP variance.
N var. Got it.
Yeah, N var. Obviously, which means the notional principle on the variance. Right.
Got it.
Now the point is another point that they're trying to make is they say that I understand what a N var is now, but what you have studied so far is not variance but Vega. In whatever volatility discussion that you had before, whatever, we have studied volatility in terms of Vega, in terms of Greeks, right? And what was Vega? That my change in my price of the option for 1% change in volatility, right? So can I say that my N Vega is equal to my change in price upon 1% change in volatility?
One sec. N Vega is equal to change in price.
Option price divided by 1% change in volatility.
Yeah. What is N Vega? Vega.
So basically, yeah, Vega only.
Ah.
Right?
Yeah.
Now let's just try to understand what a 1% change in volatility is. Can I say that if my, let's say, if my volatility is X, so I'm referring to X plus 1 square minus X square. This is 1% change. Anything is X.
Oh, yeah. Correct.
I'm referring to 1% change, right?
Correct.
So can I write it this way? X square plus 1 plus 2x minus X square.
Yep.
This becomes 2x plus 1, right? So this 2x plus 1 is usually being treated as 2x only. So the thing that I've explained you, this is not in your books anywhere, but I'm telling you, they give you a formula that this has been given by N Vega. They give you a formula that your notional principle N Vega is being given by your change in price, right, by 2K.
Got it.
But the question is, and then they say this K is again the implied volatility. Something that you know it today. But we don't understand a lot of forums and a lot of places, they say, how does this 2K come from? Right? But there's just an approximation of this 2K plus 1 because it represents 1% change in the volatility.
Got it.
Right? Now, let's just try to understand what this overall means now, and then we will just try to reshuffle a few things and then we'll see how it works. So can I say overall that my N Vega is being given by, again, N var, which is a notional principle, multiply your 2K, the change in the volatility. N Vega is the change in the notional principle. Anything that you call it as that, okay, I spend 100 million and then I'm looking at a 1% change.
Can you repeat this? Sorry.
Yeah, I'm saying
Yeah.
in
So had you till N Vega is equal to change in price divided by 2K.
yeah, let's see. Can I say that if I'm looking at my N Vega represents my 1% change in volatility,
Yeah.
right? Which has
Yeah.
been represented by 2K.
Yeah.
We talked about it.
Correct.
On how much value? On a notional principal, right? So can I say that my N Vega is being given by N var multiply my change in my volatility, which is being given by 2K?
No, this I didn't understand. I don't know how you went from N var into 2K.
Okay, all right. Let's go back one more step. We talked about that my Vega, right? Vega has been given by change in my notional principal. Sorry, a change in my option premium divided by 1% change in volatility.
Yeah.
So far, so good.
So far, so good.
Now, I'm saying this is my change in my premium of the option premium.
Yeah.
Now, what I'm trying to say is that if I have to calculate that you have a portfolio of 100 million and there is a 1% change in the volatility, is it not being given by N Vega? My change in the, think about this. So if I say that my portfolio changes by 1%,
Yeah.
right? So if my original portfolio value was 100 million, and if there is a change in volatility by 1%,
Yeah.
so can I say that my portfolio will be up or down by 1%?
Yeah. Correct.
Can we say that?
Yeah.
So can I say that the change, it is
Oh,
happening
okay. Got it.
because of, and this is my total notional because of my Vega?
Absolutely.
Can I say that?
Yeah. Yeah.
So very similar to, think about this, when I said that my profit or loss is being given by N var multiply sigma minus K square, is it not as good as my change because of the volatility? But I'm not subtracting over here anything because I'm just looking at profit or loss over here. But on
Yeah.
an individual level, can I say that it is still going to be N var multiply sigma square something at one level in terms
Yeah.
of how much
Yeah.
I get, and it will be N var multiply K square and how much I give.
Yeah.
That's how I calculate my profit and loss when I get versus what I give.
Correct.
That's my profit or loss, right?
Yeah.
Are you following so far?
Yeah. Following.
Okay. So can I say, so in that case, can I say that my N Vega is equal to my N var multiply 2K,
Yeah.
which is my change in 1%, obviously.
Yep.
Right? Okay. So if you're good so far, so the only point that is left out is rearranging everything that we already know. So can I say, and I know that my profit or loss has been given by N var multiply sigma square minus K square. And I know that my N var is being given by my N Vega is being given by N var multiply 2K. I'm bringing it over here. So I can say that my N var is my N Vega by 2K multiply sigma square minus K square is my profit or loss. So the whole exercise that we did was, because when it comes to volatility, what we usually use in the real world is in terms of Vega and not in terms of VAR. So it just tried to convert everything in terms of Vega only.
Okay.
Otherwise, the original formula is absolutely right.
Okay.
This is K and this is also K. In case you get a question on these things, and we will solve a question on this, so you will have to, everything will be given to you, even N Vega and var k, etc.
Got it. Got it.
Is it clear?
Clear.
Now, one more thing that is added to this is that if you realize that since this is a variance swap, we always talk in terms of variance, basically square, especially this, isn't it?
Yeah.
This would be the realized volatility or the variance towards the end of the contract, right? But the K, which is the implied volatility, right, is the volatility that you see today.
Correct.
Is the world that you see today. And then if you look at this K, so basically this portion is in square terms, and this volatility is in linear term.
Yeah. Yeah.
It's not square, right? So the problem with this is that when you look at your profit and loss, for a small profit or for a small loss, you don't see much of a change. But when you look at a large profit or large loss, the impact is huge, which means that the curve of this whole thing is actually convex. And the reason being because this volatility is increasing or decreasing at a linear rate, and you see an impact in the square terms. Right? So what they're trying to say over this in this topic is it is important to understand that the payoff diagram of this profit or loss of the volatility is convex in nature, which means that if in a variance swap the change of the profit or loss is small, right, you will not see much change. Think about this, from here to here you will not see much change. But when the profit or losses are huge, it is really pronounced. As you go down, you will see that it is much more pronounced. Is that okay?
Yep.
Okay. Now, last thing, it is fairly simple. All these things are conceptual, so I'm speaking all of those things so that in case you get a question on this theoretically, you can solve it. But when it comes to solving a question, I'll show you how simple it is. So maybe you can get a question that on a timeline, let's say this is t equal to 0. This is overall period of, let's say, you can call it as, let's say, 9 months. And this is 2 months. And let's say you want to calculate, you will have some value over here. So obviously we solve a question, but just making you understand that if you are standing over here, and you know the overall, sorry.
No, sir. Please continue. I just said, yeah.
Can I say that this time is actually 2/9?
Yep.
And this is actually 7/9?
Yep.
So can I say that if I know the volatility over here, right? So is it say that the total volatility of the whole period is being given by sigma square? Because now it is, I'm standing over here, so this has been realized now. This has been realized. So can I say that this is equal to, this is, let's say, the 2/9 plus something that is not being realized, this much amount, which is implied volatility for 7/9 period, multiply 7/9. Can I say that this is the expected variance to maturity? Now, why did I discuss this question to you? Because this is easy to understand, but the reason why I'm doing is, why am I using sigma over here in this? Why am I using k square over here in this? Is the reason because if I'm standing over here, I would know how much I have already realized, and for this period, since I don't know, I would still be using the implied volatility, which is k.
But that implied volatility k will be different from the k and t is equal to 0, right?
Absolutely.
Yeah.
I agree with you. So the KF from here will be different from KF from here.
Yeah.
Right. So in the question, when they give you a question, they will obviously give you at what point in time it is.
Yeah.
Is that okay? All right.
Yeah.
Just to be sure if we are okay with the concept.
9 months have passed and the S&P has realized a volatility of 21%. Calculate the current value of the swap. Okay. I haven't got my calculator today as well, but for sure.
You got to calculate today?
No, I didn't. Not at
Okay. But
But
God, this is important. We are taking
yeah.
this lightly, but then, okay.
No, I know. Sorry. I'll
No worries.
definitely get it by next week.
To be honest, you are a level 3 candidate, so I'm least bothered. Least bothered as in I know you will do it, so I'm okay. When I take
Right.
level 1, so people who don't
Mm.
bring calculator in the quants class, I just ask them to leave.
Oh. Oh, damn.
I'm little strict in that terms because अगर quants के लिए भी calculator use नहीं किया तो फिर what is the point?
Yeah. No, makes sense.
And especially when you are in level 1, you need to get your
you
hands
need to
on.
get used to it also, like.
Exactly, वही कह रहा हूँ. So now that you are in level 3, I'm okay that you will know,
but still.
you know how to do it. ठीक है.
But still,
Let us
yes.
Confused?
I got 517.5.
517.5, and what is that?
The current value of the swap.
Okay.
So what I did first was I calculated. So it's basically the formula to use is the N bar into realized variance minus the strike variance. So for the realized variance part, you know that in 9 months, 21% is the variance already realized. 21% is the volatility already realized. So what you do 21% square into 9 divided by 12 plus 3 divided by 12 into the implied volatility for 3 months, which is 22% square. That, so for the first term, that is essentially 0.0441 into 3 by 4, which is 0.033075. And for the second term, it's basically 0.0484 divided by 4. So the sum of that gives you 0.045175 minus the strike price, which is 20% square, which is minus 0.04. The difference of those two terms into 100,000, which is your notional, gives you essentially the profit and loss. Is that the same as the value of the swap? 517.5.
You're almost there, almost. The only thing that I would say is, haven't you considered 100,000 as N var?
Yeah.
But that's what's given over here is N notional.
Oh,
Sorry,
Vega notional. Vega notional. Okay. So basically, I need to do 100,000 divided by 2 into 20%.
Correct.
So that is 250,000. 250,000 into the difference that I had just said, 0.00515175. So 1,293.75.
200,000, 293.7.
Yeah, 1,293.75.
129,375.
Yeah.
Okay. And is that the right answer? And is that the answer?
Yeah.
Okay. Now, one thing that probably is missed, let's just talk that as well. I'm assuming you created a timeline, right? Have you? Did you create a timeline?
I should have done. No, it's fine. Okay, yeah.
Okay.
I mean, I didn't create a timeline.
Okay. So basically, it was 0, and it was 12, right?
Yeah.
And that they said that it is N Vega is being given by 100,000.
Yeah.
K is 20.
K is
And then say
20%.
9 months have passed and it is 21%. So I'll call it as 9, right? So it said sigma here is 21%. Can I say?
Yeah.
And then let's say strike price for you mentioned, right, that if you are standing over here, then the K will be different from this. And I said yes. So K for this is 21%, right? Do we agree? Sorry,
Yeah.
22%,
Yeah.
right?
Yeah.
So let's just write formula on what are we trying to achieve. The profit and loss is being given by N var multiply sigma square minus K square. Let's
Oh,
just
okay.
first
Okay. I know what I missed. You basically present value. That's why they've given
yeah.
the.
So this is you rightly did, right? That you are
Yeah.
doing 20. One thing is you did everything in decimals. I would highly encourage don't convert in decimals immediately, because
Okay.
when you do a lot of decimals, you tend to round off a lot of things.
Okay. Okay.
क्योंकि
So
अगर
then
आपने
what
पे
do
calculate
I just
किया
do
हुआ है
21 square, is it? I'll just do 21 square.
No, I agree. But I'm saying on 21 square, did you do 21 square or did you do 0.0021 square or something?
Yeah, I did 0.21 square.
Yeah, so what I'm saying is I
Ah,
encourage you to do 21 square क्योंकि होगा
got
ये
it.
कि जैसे आपने कैलकुलेटर में let's say 4 decimal places set किया हुआ है.
Got it.
You know how to set the calculator up to 4 decimal places, right? Or 5
Yeah,
decimal
yeah,
places.
yeah.
So no matter what calculation you do, it will change it to 4 decimal places only.
Yeah.
ठीक है? So when you do a lot of plus and minus and multiply, वो automatically कहीं ना कहीं rounding off करता जा रहा है internally. तो बेस्ट थिंग इज यू डू बाद में देखेंगे उसको जब वैल्यू पूरी आ जाएगी तो जस्ट बीच में काटना ही तो है उसको मेरी वैल्यू बड़ी आ रही होगी और एग्जाम में जो आंसर वो छोटा होगा दैट्स अबाउट इट राइट बट एटलीस्ट आई विल बी एबल टू मैच द एग्जैक्ट नंबर सो आई डू अ 21 स्क्वायर you rightly did and plus you do a 22 square multiply 3 by 12 so
Yeah.
this part you did right and then you said which was great and then you said Ankur this is my sigma square so I will effectively have to subtract my this which is my 20 square, right? So far so good. And then you realize that you were using as n variance, but it is the question given is n Vega, and we know that my n Vega has been given by sorry n variance has been given by n Vega by 2k. So effectively I need to do 100,000 divided by 2 multiply 20. Is that okay?
Yeah.
Now that we solve everything, the last bit was that whatever we have calculated so far is my profit and loss at this point.
Yeah. At which point? Sorry, at A.
At A.
Right.
Whatever you are calculating at point A. That because the transaction would happen at point A.
I thought it would be the value at point at 9 months.
This?
Yeah.
No. Yeah. Okay, and why is that so? So if it is at this
you
point,
realize, yeah. I understand. It's A at 12 months.
Right? Exactly. So this is at this place because you are also encountering this part as well and this part. Although you are standing here, so you're saying the realized volatility, the one that you are using as you're using K, right? In this place, implied, because that's not yet been realized. So effectively, this has been realized. So you're using sigma here for this place and K for this place. Ultimately, the profit and loss that you're going to get at A. Finally, you are being asked to calculate the value at this point in time, which is let's say B. Right? So all you need to do is you need to discount it back to this amount, which is how many months? It is 3 by 12. But the crux here is, look at this. What does it say? The annual interest is 2%. So ultimately, you will again have to do 2% multiply 3 by 12.
Yep.
Right? So this is how much? 4, basically 0.5%.
Yep.
So whatever value that you get for A, you have to do A divided by 1.005.
Yeah.
100% sure?
100% sure.
Okay, great. Now, I have one question for you, not related to this, obviously, something else. So, Gaurav, we have been going at a good pace throughout,
Yeah.
right? And I think these three, four topics constitute one of your book completely, if I'm not wrong.
Oh,
This
nice.
represents, isn't it? I mean, I don't know.
One sec.
How
I
does it-
have the book in front of me. One sec.
Oh, you have it?
Yeah. Derivative and
Okay.
Risk Management. This is a curriculum book.
Because I actually have an old book, so I don't know if this represents your half
Yeah,
of your
yeah.
book.
I will just tell you. So
Which,
they've clubbed derivative and risk management together. So we're done with learning module 1, which is option strategies. We're done with learning module 2, which is swaps, forwards, and future strategies.
which book it is? Book
This is book volume 4, 2025.
volume
So
4.
this is fourth book.
Okay.
Yeah. Just a sec. Cash equitization. I'm just reading the last topics. So I think what we haven't done is one sec.
But no worries, bro. I was telling you something else, right? So my idea is that we usually spend, let's say, 10 hours on that, right?
Yeah.
But we are spending almost like 15 hours on this. So I am perfectly okay because this is like a bespoke program for you. My
Yeah.
only question is there are some more questions related to what we have studied so far.
Yeah.
Right. We'll go through them so that you will be confident. And when you open your book, you will be very sure that, okay, I know all of those stuff. Or maybe we can skip those and then go to the next topic. So I wanted to know from you, how do you want us to proceed? Shall we try a few more questions so that you will be sure, or should we skip those?
Why don't we skip? I will solve the questions on my own in this book, especially the last. They have these tests after each learning module, which are like 23 questions after each learning module. So I will solve them over this week, and when we have the session next, I will let you know if I'm feeling comfortable.
Okay. All right. So if that's the case, we'll not solve everything then. I still want you to solve at least, although we could have solved all of these questions, but let's just skip this for now. I'm just leaving all the easy questions. I know you
I
will
think
be
the only thing missing is, so there is this topic like the currency management.
that's completely left for now.
That is left, right?
Yeah, we haven't even started it.
Oh, perfect. Yes, then we have done everything. I think the only thing is using Fed funds rate to infer the expected average federal funds rate.
Yeah, I'm going to cover that. I'm going to cover that now.
Yeah, okay, that was the only one, I think.
Yeah. So when we look at a standard program, we usually cover 60-70%. But this time I'm covering everything that is there in the book so that when you go back, you can only focus on what you know and what you're studying over here in class with me. I'm covering everything so that you will just have to solve the question and would not have to go to the theory again.
Yeah.
All right. But 1 second. For the questions that I know that you will be able to solve, I'm sure. But there are a few questions that require.
Yeah, we can do those.
Okay. I wanted to look at this question. Let me see if I can get everything on one page. Okay. So basically the last line says determine the future positions, right? So basically they are looking for the number of contracts.
Yeah. Okay. Got it.
And this is a good question. You can spend 5 minutes, but I really wanted to solve this and understand if you're okay with this.
Okay, we can go down. Okay, this is it. Okay.
How does it look? Difficult, easy?
Yeah, I think it's just the formulas that I have to really be um, really
Target
be
minus, target minus initial by reference.
what?
Target minus
Yeah,
current. Final minus initial by reference.
yeah. Um, but in so okay, let's just do the first equity part. So for the equity part, I don't have to change my portfolio beta, right? Because I just have to gain 7 million of exposure more. So I was thinking it would just be 7 million divided by 2930 into 250 will be the number of contracts I need to gain that exposure. Or do I need to make the 0.81?
What do you think?
Yeah, I think I need to make the the beta one as well because I need to get complete exposure to US large cap. So basically, it would be 1 minus 0.8 divided by 1 into 7 million divided by 2930 into 250.
But एक बात मुझे बताओ.
Hmm.
Okay, I'm just thinking. So think about this, Gaurav. Currently, they have 140,
140, okay.
and the target is okay. Do one thing. Just solve whatever you can. Okay. The reason is why if I'm going to tell you something, you will only think in that direction.
Mm-hmm.
Whatever, just look at every information and solve whatever you could, and then we will discuss. Maybe take another two minutes. Sometimes they give you a lot of information.
Mm-hmm.
Okay. But let's just do it.
Yeah, I think we should just solve it together. So I could only do the equity part, which I did as 1 minus 0.8 divided by 1 into 7 million divided by 2930 into 250.
Mm-hmm.
And I got that as just like 1.91 contracts. I don't know if that makes sense. Seems too low. Two contracts. But the way I was thinking about it is to increase exposure by 7 million. You buy two future contracts.
That's not bad. You can always buy two contracts. Acha, ठीक है. Let's just look at this. So it says Josh is the fund manager for portfolio that has target asset allocation of 70% equity, 30% bonds. ठीक है?
Yeah.
So they say the portfolio increased in value from 200 to 210
Yeah.
over the previous month. So the value got increased from 200 to 210. So that's
Yeah.
how he really want to shuffle. And what is needed to maintain the target allocation. So they say whatever target that they want to achieve, they have mentioned this in the table.
Mm-hmm.
So they say initially it is 140
Yeah.
and they want to increase it to 147.
Mm-hmm.
So can I say that they are trying to increase, they're trying to increase by 7 million?
Mm-hmm.
So can I say, and since I'm only looking at 7 million, can I say that I'm effectively increasing from 0 to 7?
Yeah.
भाई अगर रेफरेंस हम 140 ले लेते हैं as a reference of 140, you are increasing from 0 to 7.
Yeah.
Right? So can I say that when it comes to increasing, you are putting your cash, you are giving away cash, right? And you are achieving the portfolio beta, right? When the
Yeah.
equity portfolio beta is 0.8.
Yeah.
So isn't it something that you're trying to achieve 0.8, which is your existing portfolio beta?
Yeah. Yeah.
And you are getting this from 0.
Mm-hmm. Mm-hmm.
And then you are using the reference which is S&P 500 futures beta. This is the reference. You should nowhere be using this information, because all this information in the second table is being used for reference only. Reference as in CDD reference, fixed income reference, or your beta reference. Basically the future information. So the formula was beta of target minus the beta of portfolio upon beta of future, right, multiplied market value of the portfolio divided by. This was a formula that we studied before.
Yes.
So my point is that in this case, when you are moving from 0 to 7, isn't your beta of the portfolio is 0 for that 7 million only?
Correct.
I'm not referring to 140 at all right now. I'm just referring to the new dollar amount that you want to invest that has a beta of 0. Right? And from 0, you are targeting 0.8, which is the existing beta of the portfolio.
Right.
And then the beta of the futures is 1, obviously.
Yeah.
Right? So it is going to be 0.8 minus 0 divided by 1. And then what is the market value of the portfolio? Is 7 million.
Yeah.
Right? Upon what is the value of the futures?
2930 into 250.
2930?
Yeah.
Or 2930 multiply?
Yeah. 250.
No doubt about it. All right. Always remember, it doesn't have a dollar amount.
Correct.
They will go hand in hand every single time. So this is going to be 2930 multiply 250.
Yeah.
Does it make sense now?
Makes sense.
Okay. And before even solving it, can you imagine that when you are trying to change your exposure, basically you're trying to sell it or decrease your exposure. So can I say that my target exposure will then be 0?
Right.
When you're reducing your exposure, you're not changing your exposure, that my value was target was 3 and then I'm increasing it to 5, or from 3 I'm decreasing it to 2. No, it's saying you are selling it off. When you're selling it off, the target of that 7 million in the fixed income is not going to be 0, isn't it?
Correct.
And then whatever it is going to be for the fixed income, and then whatever is going to be something here, and whatever it is, we will solve that now. But the point is, do you understand that for fixed income, then the target will be 0?
0. Yeah.
Understood?
Understood.
Okay. Now I'm just quickly writing the formula for you, and I wanted to solve it for fixed income so that it will come as a refresher. So do you remember that it was BPV?
Correct.
Of the target
minus
BPV of the portfolio, divide by BPV of the CTD. Multiply conversion factor. You know the formula, you have everything ready, you just need to solve it. The BPV of the portfolio has been given by the modified duration multiply 1 BEPS multiply market value of the portfolio. And let me know if you want me to write the formula as well, but I expected that you would have somewhere in your notebook. So this effectively is going to be 0 in this case. And this of the portfolio will be given by the modified duration of the portfolio. Is it given? Yeah. Right? So this I'm calling it as A. So A is been given by 9.5 multiply 0.0001 because it's 1 BEPS multiply how much value that we're looking at is 7 million. And let me call this as B. So the calculation of B will be given by, do we have the modified duration of CTD? Yeah, it's given 8.5 multiply 0.0001. And we know how to calculate the value, right? The value is 110.25. And we know that we need to multiply by 1000. How? Divide by 100 into 100,000 per par value. We talked about it before. and you have the conversion factor already. It has been given by 0. This value 0.8140. Does it make sense?
Hey, hi uncle. Can you hear me?
Yeah, I can hear you. Oh, were you not able to hear me before?
No, I got dropped off because my internet stopped working.
Oh, I'm sorry. I just thought that I'm speaking and somewhere probably you are in mute or you're solving it.
No. I got
Okay.
dropped off. So I just wrote down the formula and I was about to solve it.
Okay. Your voice is a little low now. Are you speaking from a length?
Can you hear me now?
Yeah, I can hear you very well now. Yeah. So I was solving on your behalf and probably you missed it, but I'm saying the BPV of the target is now 0.
Yes.
And I helped you and I called that as A, and I said it is the modified duration of the portfolio, which is being given by 9.5 over here, right?
Understood.
And 0001 multiplied 7 million is what we're talking about.
Yeah.
And this one, if I'm calling that as B, then it is actually 8.5, right? Of the modified the CTD, and then again 1 bips, and then we know the CTD price, but we know how does it work, right? We multiply this with 1,000.
Yeah.
Par value divided by 100 multiply 100,000, so that makes it multiply 1,000, and you already know the conversion factor, which is 0.8140. You plug in over here, and that's how you get the number of contracts.
Got it. Very clear. Very clear.
Okay. So one last question, and this is again very lengthy to read, and I really wanted to get accustomed to these things so that you will be able to solve these in the exam.
Yeah.
Let me know if you can still see.
I can see it. If you could just zoom. Oh yeah, no, I can see it.
Look at the length of the question.
Right. Oh, and it's in yen also. Jesus. The word transaction goes in. You have the closest characteristics with her existing sub portfolios. Okay, I've read it. Should we go down or like basically?
No, that's about it. So the question says, which have the closest characteristics with their existing sub portfolios?
Yeah.
And then just think about this. If in case you know the question, right? To avoid transaction costs involving physically changing the fund allocation, decides to use equity or fixed income swaps, right? She has identified the following indexes which have the closest characteristics with her existing sub portfolios. अभी ये चार चीज करनी है उसको.
Got it. These are swaps, is it? Like not futures, like the previous question.
They are the indexes, but she's saying that she's okay to get into a equity or fixed income swap.
Okay.
So what should we do? So let's go one by one, right? So the first one is Weber wants to reduce the exposure to value stock portfolio.
Correct.
Okay.
So basically what she will do is she will want exposure to the growth and she's ready to give up exposure to value. So she'll engage in a swap that gives her returns of the growth in exchange for returns of value. See that?
Okay, this is, but okay, this is another way of looking at it. Yeah, that I wouldn't say that's wrong exactly. It's just that the notional principles are different.
Right.
So it will make some transactions a little difficult. But what you can do is think about this. How about that you give away all the returns that you have on a notional principle of 5179200000 on this amount.
Yeah.
On this amount. How about that you give away all the returns and you receive what does she think? Let me just read this through. I haven't read it. It is a portfolio manager running this much. The fund has a current value of this. The invested in within the equity, the fund is split into within the fixed income. Wants to alter the portfolio in fixed income and alter the allocation to sub funds. The following to summarize to avoid transaction one. I want to decide to okay. So it doesn't talk about anything related to whether she would get into receive fixed or receive floating.
Yeah. Yeah.
Right. So that's not very clear.
Yeah.
But maybe in the exam they will give you additional information, I'm sure.
Okay.
Right, to solve this question. But at least for now, we know that one of the good ways to go about this is that we give away returns on MSCI Japan Value Index.
Yes. Yes.
And in return, I can get maybe floating rate, whatever it's happening, whatever it's the prevailing rate is. Right. So that will be my equity float swap.
What will be the notional for the swap? It'll be this
15179200000.
Got it.
Okay.
Clear.
The second one is again growth.
Yeah, she will.
So in this case, I can pay some reference rate and I can receive this much on the notional this much.
Yeah.
Right. How about the fixed income?
You will pay some. You pay some floating rate and receive the S&P Japanese government bond index.
Perfect. And the last one is on the government bond.
Same one.
Same ones, right?
You will receive. You will pay sort of floating and receive corporate bond index.
No. Even in fourth one, it's a plus, right?
Yeah.
So I want to get exposure. So I will not be. Oh, you will pay float. Oh yeah, you're right.
Yeah.
I'm paying some float so that I can receive the returns on the corporate bond index, right?
Yeah.
Okay, perfect. Yes, that's what we want to do. Okay, good enough.
Yeah.
All right. So if we know the basics, if we know what needs to be done, so obviously in the exam they will not leave you hanging. They will tell you that the available options are this much, maybe a reference rate or something. So how would the transaction would go, and would ask you to solve some questions. But at least you know what needs to be done, right?
Yeah.
All right. The last topic in this is, now that we have studied almost everything in this topic, one thing that they talk about is, how would I know? There are so many things that we looked at, right? How would I know which product is useful in which kind of scenario? So what they say is, and something that you read it out, that market expectation using Fed fund futures, right? So what they're trying to say is that if my concern is inflation, then I should think about CPI swaps, because this is related to inflation. If my concern is volatility, I should think about VIX futures.
Yeah.
Right. And if my concern is Fed, when I say Fed, basically the interest movement. Right. In that case, I should think about Fed fund futures. Right. So what they say is, so basically they elaborate this a bit more on how these Fed fund futures works, right? And how do we calculate something? We'll talk about that. But the idea that they're trying to say is that they use the word something called as FOMC. FOMC represents Fed Open Market Committee. Right. So in that they explained something called as Fed fund rates. We know what a Fed fund rates are.
Yep.
The Fed fund rates are the overnight rates.
Yeah.
or maybe we can say the Fed rate, right? Basically, the simple Fed rate are the overnight rate, जो कि interbank आपस में, it is basically if there are 18 banks that they are looking at, and they look at the overnight rate of every bank, and then they calculate the weighted average number that will give you the Fed fund rate.
Got it.
And obviously, there's something called as Fed fund target rate.
Okay.
Right. Obviously, what they keep it as, right? What are this monetary policy committee meeting, MPC meeting?
Yes.
Right? So even every time they put a target of 2 to 2.5%, then they say that if the inflation is going up or going down, on how do we really decrease or increase the interest rates?
Correct.
Right. So they put a Fed fund target rate that, okay, based on the inflation, we would like to keep the interest rate as 2%, depending upon how the inflation would look like. Or maybe in India, it is, let's say, 5.5 or 6.75. Right. But one thing that they say is that in case you are really concerned about if the Fed is going to increase or decrease the interest rates this time, then to avoid that situation, you can actually invest into Fed fund futures.
Got it.
And isn't it very similar to any other future that we have discussed?
Yes.
Right. If you believe that the interest rates are going to go up, etc., or go down, or maybe you have a position where you think that the change in the interest rate will impact your portfolio, then you take a long or short position accordingly to hedge your position.
Yeah.
Because these Fed fund futures are obviously in line with the Fed fund rates.
Yep.
Right. So what they're trying to say is that in case you have a long position, then you can go short on these futures and you can effectively hedge your position. All right. And obviously, you need to be cognizant of the fact that these are the futures. So the hedging might not be 100% perfect.
Yeah.
Right. Now, the one thing, the last formula that they give in this is that is not very intuitive, I would say. Right. But then you can get a question on this straight away. They say, what is the probability?
Okay. Oh, yeah.
Of the rate change? What is the chance of a rate change? Right. So one thing you can imagine that if it's a probability, it has to be rate by rate.
Yes.
Even numerator and denominator has to be both rates.
Yeah.
Right. So the formula that they give is implied rate minus the current rate divided by the rate assuming Fed would change the rate. Basically, the Fed changes the rate minus the current rate. Basically, the idea is that they are saying that assuming that whatever the implied rate is as of now, divided by the current rate is going to be basically the change in the rate, what we expect.
Yes.
As of today. And the next is divided by what actually happens when the change would happen. Right. Because that represents the rate, assuming the Fed changes the rate.
Yeah.
And then this is like the actual thing that would have happened after the change in the rate. And then the difference will give you the actual change versus you are looking at the expected change for now. And the ratio will give you the probability of change. Now I'll go a little bit in detail in understanding what the implied rate would be. Right. So the implied rate is being given by 100 minus Fed fund future rate. We did something similarly. You remember that?
STIR.
Percentage.
STIR, right?
Yeah, exactly. STIR. Absolutely. Right. So if I say that it is going to be, let's say, 1.5%, etc. So you subtract and get the value.
Okay.
Is that okay?
So implied rate is 100 minus Fed fund future rate, is it?
So this is the Fed futures price, futures not rate, actually price,
Price. Okay.
price, not the rate, price, right? So if I'm saying that my Fed future price is, let's say 99 and this is 100, so my implied rate would be 1%.
Mm-hmm.
Make sense? And whatever the current rate would be, they'll give you the current rate in the question.
So I just had one question. Suppose that the future Fed fund rate was 1%. How would you calculate the price of the future?
No, sir. Sorry. They give you the future price. This is the futures price.
Yeah, I just wanted to figure out. Suppose how is this 99 derived? It's like a market rate.
Oh, no. Yeah. You don't have derived 99. It is the current market futures price for any contract.
I see.
So it is as good as a forward or a future contract that is being sold at spot.
I see.
Right. So you would say that currently the futures price of a Fed fund is being traded at 99. So that's your future price.
Understood.
So the Fed fund rate would be 100 minus 99 is going to be 1%.
Yeah.
Right. And then they might ask you what is left. You will given the current rate. You will be given implied rate is just we have calculated. And yes. And then they say, what is the rate assuming the Fed has changed the rate?
Okay. Basically 50 bips, 100 bips.
Absolutely.
So
whatever the current rate would be, you will add that percentage to it.
Okay.
Right. So if the current rate is, let's say 2%, and they assume that the Fed might increase 50 bips, so that will be 2.5%. Is your guess?
Yeah. Very clear.
Clear?
Yep.
Okay. Let's just solve one question. Very simple. So here in this case, the current Fed fund rate isn't given in a range, right?
Oh, yeah. Yeah.
So there is no set pattern, but if nothing is given, I think the best way to go about this is take an average.
Perfect.
If they give you a definite number, good for you. So when they use the word, what is the expected average FFE? They are referring to the implied rate.
They're referring to the implied. Okay, got it. That'll just be 100 minus the.
Sometimes the language is not very clear, but the expected average FFE rate is the implied rate.
Got it. So the implied rate is basically 1.8375.
Great. One thing, Gaurav, let me just write this quickly, because you might have this in recording and then this might help you somewhere later. So implied rate, or they might use the word implied Fed fund effective rate.
Okay.
Or they might also use the word average Fed fund effective rate, right? So this is actually average FFE, average Fed fund effective rate, right? Or implied Fed fund effective rate, or just the implied rate, right? So they could use these words interchangeably. So you should know when they look at the word average FFE versus implied rate. Look at this one. Can you see here? Implied Fed funds effective rate.
Yeah.
It's the same. And the average FFE is also same.
Got it.
Okay. So you're right. 1.8375 is the right answer. Then how about we need to calculate the current rate?
Yeah.
What is that?
So it's 1.8375 minus 1.625 in the numerator. And in the denominator, it's basically 1.875, which is the 25 bip increase.
Great.
Over 1.625. So 1.875 minus 1.625. So the answer is 85% probability.
So the change, the probability of the change is 85%.
Yeah.
Right. Okay. Perfect. So probably this is how these people on Bloomberg speak about that. We don't think that there is going to be any change, etc.
Yeah.
Based
Yeah.
on these things, because obviously when people are going to expect more or expect less, the future
Got it.
price would change, contract value.
Got it.
And this will also give you an estimate of, think about this, when, okay, let's just do this. It is not in your books, but let's just try to understand. If this value increases, if Fed future price increases, my implied rate reduces.
Yes.
Can you hear me?
Yes. Yes.
If my future price increases,
Yeah.
then my implied rate reduces.
Yeah.
If my implied rate reduces, assuming everything else same, then the probability of change would reduces,
Yes.
because my this part, I'm calling it as C is derived from B, if this is B,
Yeah.
right? So my C is derived from B,
Correct.
and my B is here, and my A is independent,
Correct.
which is depend on the future prices.
Mm-hmm.
So can I say that everything else same, if my future prices increases, then the probability or the chance of Fed increasing the rate would reduces,
Yeah.
right? So that's how the market, the market leaders, the big economists, they look at this price, and then they put a probability of 0.25 versus 0.5 versus other
Yeah.
changes, and they see what is the chance that the Fed is going to increase the rate or reduce the rate.
Yeah.
Does it make sense?
Makes sense.
Okay, so I just gave you another explanation on how my future prices now somehow correlates with the increase in the probability of the Fed change in price, change in rates.
Mm-hmm.
ठीक है? So far so good?
So far, so good.
Okay. I think we have spent a lot of time on these topics, and I hope that when you read these in your book, you will be confident in solving the questions.
Yeah.
So when it comes to currency management, two important points that we need to understand. One is price currency. Some of these things would come as a refresher to you because you would know it already. And another one is base currency.
Right.
Right. Just remember, the price currency will always be in numerator.
Okay.
And the base currency is in denominator. And we always speak in terms of base currency.
Hmm.
Right. So when I say, let's say, I would say 500,000 maybe USD by CHF equal to, let's say, 1.08, right? So I would say to buy 500,000 CHF, right? I can buy this many CHF and I can sell obviously 500,000 multiply 1.08 USD.
Got it.
Makes sense. So the idea here is that we spoke in terms of CHF and not really USD. Obviously, the other way around would be true. But when we look at this number, we usually say in terms of the base currency. Another thing is the bid-ask spread. When it comes to bid-ask spread, which is a smaller number, bid or ask?
Bid.
So tell me something. Do we buy at bid or do we buy at ask?
We buy at ask.
Buy at ask, and then we sell it.
Ask.
Sell at ask.
Mm.
Buy at ask and sell at ask. Oh, that's not possible.
Yeah.
So there's one thumb rule that I usually tell my CFA level 1 candidates, and I tell them that no matter what happens, always remember this till CFA level 3. And that the basic rule is that there are two basic rules. One thing is we will always be at loss. हमेशा. ठीक है? We are not here to make the money. We will always make a loss. It clearly means that you will have to buy expensive and sell cheap. तभी तो मेरा लॉस होगा.
Yeah.
And loss ही होगा क्योंकि think about this. If somehow I can let's look at a bid ask spread of 95 and 98.
Yeah.
If somehow I can buy at 95 and I can sell at 98, मतलब लाइफ में कुछ और करने की जरूरत ही नहीं है फिर.
Right.
पूरे दिन बैठ के यही करते रहो, बिड आस्क स्प्रेड पे खेलो, and you can be a billionaire in a day.
Yeah.
Right? But that's not the right thing to do. It's not about the right thing to do, but you're not allowed to do so. Rather, you will be the price that is available to you to buy is at 98. You will buy at 98 and you will sell at 95, making a loss of it. But then the question is, then if everybody does that, nobody makes money. Yes, people make money. Who? The dealers. Dealers always buy at this and they'll sell at this. The spread, the profit that they have is 3 rupees and the loss that we make is 3 rupees. Obviously, that becomes a zero-sum game, assuming nothing else changes.
When do dealers make a loss?
Because they are the market. They are the market makers.
Got it.
Right?
That's
Think
their
about
fees.
this.
It's like their fees for making the market.
Absolutely. That's their fees. That's the spread that they want to keep. Yeah. Look at this. They buy so many currencies, illiquid, liquid. They have, think about it, they have so many things to sell. Yeah. But you are only buying what's relevant to you. So obviously they're going to keep the spread with themselves for the market that they're making.
Yes.
Right? So the phrase that I always tell my candidate is dealers bid buy. Just remember this. Dealers bid buy. Right? Which means dealers buy at bid. So if you remember this dealer bid buy, so you would know that dealers will buy at bid. So obviously the retailers or us will only buy at ask.
Understood.
Another thing is when it comes to currencies and when they give you two currencies, and think about this, and I'm not sure whether this is relevant to you or not, but if I have something related to INR by USD, I am very comfortable because I know how it works. As in, if I have to give 1 rupee, will I get less of dollars or more of dollars? But if someone is going to give me CHF versus euro, then I'm not very comfortable because I don't know which one is more bigger currency, which one is smaller currency.
Yes.
Okay. So then it comes to what we know as an education. But in terms of USD and USD and INR, I know if I'm going to get less or more because that's something that we look at it day in day out, right? But what I'm saying, when you get two currencies, let's say A by B, and you don't know if I would be using B or I would be using A, if you're not sure about this, always look at a transaction. So if I would say this is a smaller number and this would be a bigger number, right? On a bid-ask spread, this will be a smaller number.
Yes.
And this will be a bigger number.
Yes.
Right? So when it comes to getting, choose a number which will fetch you less.
Okay.
When you are giving, choose a number which will give away more.
Okay.
Right? The reason why I'm telling you is this. Let's say you have a quotation of 0.9790, 0.9810 CAD by USD.
Okay.
Now the question is, let's say I want to buy 1 USD. Then how many CAD would you sell?
You want to buy 1 USD. So you want to get USD.
No. If you're buying, you're getting 1 USD, and you're trying to sell the CAD.
Yes. Yes.
How many will you sell? Basically, you have to pick one number, either A or B.
You will pick the higher one, 0.98.
Exactly. Does it make your life easier?
Yeah.
So I didn't know before knowing this that which number to choose, and I don't want to really get confused in terms of if I should convert bid number or ask number, if I'm buying as denominator, buying as a price currency or a base currency.
Yeah.
I don't know, and I don't want to get into those things right now. I only know that if I am giving, I have to give more because I am here to make loss.
Yeah.
Is it easy to understand?
Yeah.
Or maybe just to write the other way around is that I will be selling 0.9810 and I will be buying 1 USD. It is as good as this. Basically same thing.
Yeah.
However, if you say that I want to buy 1 CAD, then how many USD will you get away with?
You
Actually,
will.
no. Hold on. You would not actually be. I cannot. Let's not use the word CAD for now. I'll tell you why. Because that's in the price currency, and we will have to actually change the numbers. We'll talk about this later. But
Yeah.
I'm saying, can I also say that if I want to sell, I was buying USD. Let's just sell 1 USD. If you're selling 1 USD, how many CAD will you buy?
You buy the cheaper one, 0.9790.
Exactly. So now you know it.
Yeah.
Okay. Comfortable now?
Yeah.
So if they give you any kind of quotes, always remember that which quote would you use? Choose a quote which will fetch you less. And choose a quote which will give away more. Okay? Otherwise, the currency thing can be very, very confusing. Okay? All right. Know this thumb rule forever.
Yeah.
Next thing is, and that part is very easy and very interesting, that in CFA level 1, we always say that if my spot is, let's say, 1.5 and my forward point, basically the forward, how many points it could increase is, let's say, 1.25, right? So the general notion is that we convert that into bips. So what we do is 1.5 plus 1.25 divided by 10,000, and that's the forward value that you would get. Is that correct? The forward points. So do you know that whatever points that they give you, we usually divide by 10,000 because it's in bips, and then we add it to the original number. So that will be my forward price. If this is my spot price, this will be my forward price.
Okay, clear.
Right. But the interesting part over here is that we have studied this in CFA level 1 and 2, that whatever point that they give you, we always divide by 10,000 because that's in the basis point. Right. But then that's not the exact thing to do. What is the exact thing to do is you should always look at this number.
Okay.
How many decimal places does it have?
One.
Right. So effectively you should do a 1.25 divided by 10.
Okay. Okay.
If I say that my spot price is 1.65, you should do 1.65 plus 1.25 divided by 100. And if I say my spot is 1.675, you should do a 1.25 divided by 1000. And if I say this is 1.8925, then you should do a 1.8925 divided by 1.25 divided by 10,000.
And what is this word 1.25? It's bips, is it? They say it's...
Yeah. So the term that you will see in the exam would be forward point.
Got it.
But now you should know that you should look at the spot price, and then depending upon how many decimal places does it have, use the decimal places accordingly. Right? Okay, let's just see. Can you see here? If it was 1.33, all that is 1.1, we divide by 100.
Understood.
Divide by 1000, 10,000. All right. Let us look at this question.
What is the 30-day forward bid / offered quote? Yeah, so this is 1.2571 minus 1 divided by 10,000, which is 1.2570.
1.2570.
Yeah.
30 days forward bid offered quote 1.2571 minus 1 divided by 10,000.
Yeah.
Is that correct? Okay. And correspondingly 1.2574 divided by minus 0.9 divided by 10,000.
Yeah.
So how would the quote look like? 1.2570.
Yeah, 1.2570 and 1.25731.
How about the second question?
Second question is, manager sells 1,000 AUD forward 90 days. Calculate what the manager will deliver and receive. When will the exchange take place? So now he's talking in terms of price currency. Right. Okay. Let me just solve this. Let me take some time.
Oh, you want me to solve this?
No. Let me do it so that once and
Okay.
for all.
Good. Take 2-3 minutes.
Oh, it's confusing. I think I need to first do whatever the forward rate I get.
Correct.
In 90 days.
Correct.
I need to do the reciprocal of that.
Okay.
And essentially, whatever's the higher one, I will sell that.
Okay. Let's see. Try that. But I want to know the exact number.
Yeah. So 1.2571 plus 11.7 divided by 10,000.
Right.
This is effectively 1.257 71 plus 0.00017, which is effectively 1.2827. 1.25827, the reciprocal of that. So he will sell 1,000 Australian forward and buy 794,700 euros. I don't know what I've done, but basically the forward price that he will sell it for is 0.7947.
So we'll look at this together. I think you're almost there. I would not calculate the forward rate. I think you did it right. The forward rate that is being used is, can I say it is going to be 1.25827 and 1.25860. ठीक है, यही था?
Yeah.
1.25827 and 1.25860. Okay, ठीक है. And can I say that this is a smaller number?
Yeah.
And this is a bigger number. ठीक है. अब देखते हैं करना क्या है इसमें. He's trying to sell 1 million AUD.
Okay. Yeah.
Sell 1 million AUD when my spot rate, this rate is in AUD by EUR.
Yeah.
Now there are two things to understand here, and then the question will become very simple. The first thing that I need to understand is when I'm selling AUD, I am buying EUR. Correct?
Yeah.
First point. And second point is when I'm buying something, I'll buy less. Correct?
Yes.
So if I'm selling AUD, then I should actually divide AUD to get EUR in numerator. Basically that the point that I'm trying to make is that I will have to divide with some number. Is that correct?
To get euro. Yeah. Correct.
Right. So basically 1 million divided by either S or B, either small number or bigger number, will give me something in euro. Is that correct?
Yes.
Now the only challenge is which number to choose. When something is going in denominator, I want this whole number to be lower.
Yeah.
But that's something I'm going to get, and we always get less. If I'm going to get less, I would want, how would I get lesser? If I can put something in denominator which is a bigger number.
Oh yeah.
Right. So let's just use 1.25860.
Yeah.
This will give me fewer euros.
Yeah.
ठीक है. तो मतलब हमने पूरे क्वेश्चन को तोड़ मरोड़ दिया. तोड़ मरोड़ने का मतलब है कि हमें सिर्फ क्वेश्चन सॉल्व करने से मतलब है. ठीक है. मुझे इतना पता है कि मुझे CFA लेवल 3 क्लियर करना है और उसके लिए मुझे क्या जरूरी है मुझे ये पता होना चाहिए.
You have to solve the question.
ठीक है ना. So my idea is कि I am going to get lesser of the number, and how would I guess lesser of the number if I am going to use a bigger number in the denominator. तो मुझे नहीं पता कि वो बिड है, वो आज से क्या है, मैंने तो उठा के नंबर डाला और I can get the answer. Clear, right?
Clear.
Now the next thing is they talk about offsetting transactions and mark to market. I don't think I would explain anything on this to you. We know how offsetting works. We know how MTM works. Let's just straight away solve the question. But make sure you do it half right, or maybe do it full right. but whatever you do, you know what you're doing. At least ताकि वो उतना part correct हो जाए and concept एकदम clear हो जाए.
Yeah. To sell euro 10 million and an all-in forward of 1.30 days have passed and exchange rates are as follows. Okay. I don't understand this. So when he's selling euro, he has to buy AUD. Now, obviously, if he's buying AUD, he will want to buy the cheapest. So therefore, he does the 1.25827. Now, he will want.
1 second. You said you want to buy the cheapest. What does that mean?
He will have to buy Australian dollars.
You will have to buy Australian dollar. 1 second. He is to sell. Sorry, no, why?
It says over there, right? Entered into a trade to sell 90 days forward euro 10 million.
Okay.
So would he not have to buy if he's selling euro 10 million? He'll have to buy AUD, right?
हाँ, लेकिन उसमें offsetting कैसे होगी फिर?
Exactly, that's what I was confused about. So he's actually buying euro, is it?
Okay, let's just solve this. Acha, maybe maybe at least do something. Do maybe something, right? Whatever you can do, and then so that you, when I am going to solve the question, you will know गलती कहाँ हुई थी.
Yeah, I really don't know yet. I am not understanding conception.
Right. Let's just create some timeline. Based on the initial codes given the previous question, previous example, a different manager entered into a trade to sell 90-day forward euro 10 million at a forward contract of this. Okay. So can I say that he entered into a contract for 90 days that he will sell 10 million euro and receive, he gave you a all-in price of AUD by EUR equal to 1.25827. So can I say that in 90 days, he'll sell 10 million euros and receive 1.25827 multiplied 10 million AUD.
How is it different from the previous question wherein we were selling something, right, over there?
Huh. So the point is, in the previous question, we were just looking at the forward rates, and I haven't even started talking about offsetting at all. I'm saying when you have two quotes, of bid and ask, then you will think, what am I buying, what am I selling, and I want to get lesser and I want to give more. Is that correct?
Yes.
But in this question, they say that they entered into a forward contract with the all-in price of this. It means the transaction would happen at this exchange rate and there is no bid or ask per se.
Okay. Okay.
I am not even getting into any of these things for now. I'm not.
So he would sell 10 million.
Right.
Yeah, this is where I got confused. So you would sell 10 million, but he's not buying Australian dollars. He receives Australian dollars.
Yeah.
He has the 10 million.
He's not buying Australian dollars. No. He is just selling the euro 10 million. And obviously, when he's selling, he will have to receive something.
Okay,
okay. Oh, now I understand where you got confused. Okay. So So in currencies, when you give away one currency, you will get some other currency, right? So when I say that I'm going to sell my euro this much forward, and they give you exchange rate of this much, when you sell your euro, you will effectively receive AUD
Got
because
it.
they will exchange, right? Think about, okay, I'll help you relate this question again. So think about this. When I did some business in the US, I installed some of the laptops. He said that he's going to give me 100,000 USD after 1 month. And I entered into a contract to sell 100,000 USD at a rate of something with respect to INR. So doesn't it mean that when I'm going to sell 100,000 USD in future, effectively I'm going to receive some amount in INR?
Yeah.
Is that clear now?
Clear. So obviously, if the rate has gone up, you'd want to sell. You want to sell this contract that you're already in and get into like 60-day contract with the highest.
No, we'll see that. No, we'll see the offsetting thing. But
Okay.
let me confirm this first. That are you comfortable saying that if I'm going to sell my 100 million euro, so then on this day, let me call this as A.
Yeah.
On A, you will sell this much euro and you will receive this much AUD. Is this part correct?
This part is clear.
100%?
Now it's clear. Yeah.
Okay. And they give you a forward rate. So let me know if you want me to re-explain this part.
No. I got it.
Great. So you are going to receive this much AUD, no conflicts, no offsetting, no use of spot rate exchange or anything. This is the straightforward transaction. Now, let's talk about what they say now. They say 30 days have passed and the exchange rate now are the following. Now, the one thing that I want to focus on, they use the word spot. But the important thing to consider here is this spot is as of t equal to 30.
Yeah.
This is the spot that they talk about, which is 1.3189 by 1.3191. So when he is going to take a offsetting position, is it going to be for 60 days or 90 days? This is the first thing that you need to understand.
You will take it for 60 days.
Right? So you're absolutely right. So one thing that people get confused is the moment they look at the word spot, they understand it's for this and then they calculate the 90-day forward. But the question clearly says 30 days have passed. Which means now whatever offsetting that you would be doing, you're not going to do it here, right? But you will be doing it over here. Because that will now offset my position at A. Is that clear?
Okay.
So my first step is now to calculate the forward rate. And then we'll come to which rate to be used. Okay. So can I say that my forward rate is going to be 1.3189 plus 10.3 divided by 10,000?
Sorry, can you just go back? Yeah.
Okay. And can I say it is going to be, this is bid, and the ask is 1.3191 plus 10.5.
Yes.
So far, so good?
So good. Yeah.
Now that I have my forward rates, so abhi hoga kya? Let's just try to understand this first. On the graph, what happens is I'm standing over here.
Yeah.
And my original transaction is to sell euro. So isn't it something that my offsetting transaction is to buy euro?
Yes.
Buy euro, how many? Same, 10 million. Right? For 60 days.
or 60 days. Yeah. Yeah.
This
Yeah.
is I'm effectively buy euro 10 million for 60 days. That's how I would be offsetting my transaction.
Yeah.
Sure, no? Because we were selling euro initially. To offset, I will buy euro of the same amount, but the duration is this was originally for 90 days originally, but since I'm standing over here and the number of days left are 60, so I will be taking an offsetting position on 60. Clear?
Clear.
Now the last bit is how much am I going to receive? Am I going to receive? Why? Because since I'm selling euro and I'm buying euro of the same amount, so this will offset each other. Now the only thing is how much of the what AUD am I going to receive? Okay, so let's just look at these numbers first and then we'll see कि अगर मुझे receive करना है, if I have to receive AUD, obviously it is going to be the lesser number.
Obviously, it's going to be the lesser number.
Oh, actually, I have to buy, right? The offsetting position is to buy the euro.
Yeah. So you
So
want to buy as little as possible, right?
No. So this is same. The offsetting position is the same, right? So I have to sell AUD.
Yeah. Okay.
My original transaction was to sell euro. To offset, I buy euro. If I am buying euro as my offsetting position, at the end, I will be selling AUD effectively. Not selling, but give away AUD, right?
Yeah.
So when I'm gonna sell AUD, I have to give more.
You have to give more. Yeah.
Let's do one more time. Okay, let's just try to understand the dynamics again. Think about this. Leave this part. Undo नहीं होता. I don't even know if there's a way to undo this. Oh, okay. ठीक है. So far so good. That on at A, I would be selling euro.
Yeah.
And I will receive AUD. Right?
Yeah.
This is the AUD that I'm going to receive in my hand. Here.
Yeah.
Now, if I'm selling euro, and I am standing over here, the opposite of sell is buy.
Correct.
If I'm selling euro, I have to sell euro, buy euro, just to offset.
Yes.
Selling euro, opposite is buying euro.
Yeah.
For how many days? 60 days.
60 days. Yeah.
And it was 10 million, so same on 10 million.
Yeah.
Correct? Now think about this. If I am buying euro, if I am going to buy euro, then don't you think that I have to pay AUD?
If you have to buy euro, you have to pay AUD. Yes.
Clear?
Yeah.
If I'm buying euro over here, and remember, I'm getting into a contract, but the transaction would still happen at A. I'm just trying to offset a position so that whatever happens will nullify. Right? So I'll have to pay AUD. Is that correct?
Yeah.
If you are good so far, the only problem that we have now is how many AUD.
Yes.
But before calculating, do we know if I have to pay more?
Yeah. This part, can you just explain the rule of thumb?
Yeah. So if I am Receiving, I'll receive less. If I pay, I'll pay more. How will I make a loss? How will I make the loss? मुझे हमेशा लॉस होना चाहिए, मतलब मुझे हमेशा क्या बोलते हैं, when I do the transaction, right, I should always be at a deficiency base side where I would either be receiving less or paying more. This is what we understood in the last question.
Yeah. You'll be paying more. Yeah.
Look at this one. When I was buying USD, I was selling more. Look at the two quotes.
Yeah.
On these two quotes, when I was buying one USD, I was looking at the bigger number. I was selling more. When I was buying, when I was selling one USD, I was receiving less. Look at the two numbers. Take 10 seconds and let me know if you're okay.
Yeah.
And again, be mindful, I'm not really converting anything right now.
Yeah. If I
I'm just
need
giving
to...
मैं बिडास की बात भी नहीं कर रहा हूँ, मैं किसी की बात कर रहा हूँ, मैं बस इतना बोल रहा हूँ कि just remember that you always want to get less and give more.
If I need to sell USD,
Don't receive the second sentence. It's just confusing. क्योंकि ये उल्टा लगता है पढ़ने में. Don't read this. Just read this. This is just the opposite of this. मतलब वो same लिखा हुआ है घुमा के.
Yeah, I think what makes more sense to me is that suppose I need to buy USD, I have to deliver higher because the cost of buying is higher. Right?
Correct. You're absolutely right. If you're buying USD, you are delivering higher. Okay.
And if I sell one thing, I receive lesser because there's always going to be a loss.
Yeah. If you're selling you, let's just talk about in terms of base currency only. So if you're buying USD, right, you are giving away more.
Yes.
And if you're selling USD, you're getting less.
Yes. Yes.
So the rule of thumb is that you are giving more. You are giving more. And you are
selling Australian dollars, so you receive lesser euro, is it?
No. So you're not selling.
Oh, you're buying. You buy euro.
Euro.
So if you buy euro, you have to deliver higher Australian dollars.
Correct.
Okay.
So if you're buying euro, you have to deliver Australian dollar, but deliver is as good as giving or paying.
Paying, yeah.
You have to pay more.
Yeah. Clear.
Now the last bit is just calculate these numbers. These numbers turn out to be
1.3199.3.
This one?
And this one is 1.2015.
So you can imagine this number is a bigger number.
Yeah.
Right? So all you need to do is 10 million multiply 1.32015 AUD is what you're going to give. Right? Now look at everything holistically. It means that effectively without any offsetting transaction, you were receiving this much.
Yes.
And after offsetting, you are delivering this much.
Yes. So you made a loss.
Yeah. So this is actually 132,015 somewhere, maybe 0. I'm not really calculating the exact number, but and you are actually doing, and just remove 10 million for now, right? So you are giving away 1.32 and you are getting 1.25.
Yeah.
Right? So you are giving and you are getting. It's a loss.
Then why would he even come and like do this?
To do this, okay. Why? The reason is so you have a spot rate and you have forward points, right? You have a spot rate and you have forward points. Now, what if you have locked in the price today by taking offsetting position? How about that on the delivery date, on this date, the value of the spot rate at that time will be much higher than what you see over now. Then the loss will be even higher. Right? The idea here is that he's going to receive AUD, right? When this value will be too high, he will get even lesser.
Yeah.
So he thinks, and the point is, just think about this. When he's going to sell these many euros and he's going to receive this many, the idea is that he want to maximize his position or he want to minimize his loss.
Yeah.
Because on the spot date, if the AUD EUR price is volatile, then he might make even a bigger loss.
Makes sense.
Hence, he got into offsetting position so that no matter where the market moves, then he is locking the price.
Yeah.
But the last bit is that whatever profit or loss that we have calculated will be given or will be made, the profits will be realized on A. Yes or no?
Yeah. Profit or thing will be realized on A. Yeah.
You are entering into a contract, you are just entering. But the transaction would still happen on A.
Yeah.
Right? So if they ask you to calculate the mark-to-market value as of today,
yeah.
If they ask you to calculate the mark-to-market value, it clearly means that you will have to bring the value back to the present time. What does it say? Calculate the mark-to-market. So we calculate the resulting loss or gain. Okay? The question is, when will this gain or loss be settled? What is the answer to this?
At maturity, in like the next 60 days.
Right? 60 days from now. If you're looking at this today spot, so 60 days from now, this will be settled. Right? And then it says, calculate the mark to market the manager would report on date 30th of the original trade if the trade were not closed out early. Now, the point is, look at the language. They just unnecessarily complicated this by saying 30 days of the original trade. What does that mean?
On the day 30 of the original trade. Got it. Basically, at T is equal to 30.
If this is P, this is Q, and this is, let's say, 60 as R, and this is obviously A. So is it going to be P, Q, R, or A? This is 0, this is 30, this is 60, and this is 90.
It'll be Q.
Q, right? Okay, this is absolutely right. So basically what you're trying to say is, mark-to-market manager would report on 30th day of the original trade. 30th day of the original trade, basically from 0, T equal to 0 to T equal to 30. Which is at Q. ठीक है ना?
Yeah.
And we know the value at A, the profit or loss we know, right? So you just need to know the 60 days rate so that you can discount it back, isn't it?
Yeah. Oh, you know the 60-day rate, so you know how much profit or loss will happen, and then you discount it back. Got it.
Right, you have discounted plan, but just be mindful is again
Two rates.
1.2% has to be adjusted for 60 days.
Yeah. But
Right?
when I'm trying to figure out the profit or loss,
Hmm.
calculate amount of report if we're not closed out early. I mean, the 1.25827, the rate, I will compare
No,
with
no, hold on. One second. What are you saying? 1.25. Sorry, come again.
no, like what would the mark to market be?
Mark to market B. So the mark to market is the value, the something, let's say you are receiving 100 AUD, right? And you are paying 125 AUD. Effectively, your loss is 25 AUD. ठीक है?
No, but this is assuming that
हाँ.
this is assuming that I don't get into any offsetting position, right? The second question.
No, it says if the original trade, if the
Oh,
trade were not closed out early, it means what does that show? It says that if it is not closed out early, basically means that if you are not doing anything else, so what is the value as of today? Matlab, what they're trying to say is that you will still be doing everything over here and not before this. What they're trying to say is that you are not really be closing any transaction before, but you will be closing the transaction on the contract maturity. But what will be the value of that value that that you're going to receive on the maturity in terms of the present times? Does it make sense?
Yeah.
And when you say mark to market clearly means that you are really offsetting a position. That's the reason your mark to market is doing that. Let's say, by the way, let me tell you the meaning of mark to market is. The meaning of mark to market is that if you are closing out the transaction as of today, how much value that you have to pay or get.
How much value?
Either you have to pay or you will get. The mark to market concept came in. By the way, do you know that the mark to market concept is only applicable in terms of futures and not in terms of forwards?
I see. No, I didn't know that.
Okay. अच्छा, अब ये बताओ, do you know at least that the concept of margin comes in for futures?
Yeah.
भाई ये बताओ ना कि अगर ये जो हमने पूरा कॉन्सेप्ट पढ़ा था स्टार्टिंग में FRA वाला, and then you must have read this in derivatives, that the difference between futures and forwards is that there is a risk of default.
Yeah.
Right? There's a risk of default.
Yeah.
And why in futures there is no default? Why?
Because it's you have to post margin and it's like a standardized thing, right?
Correct. That lies the main crux. So when you post margin, what happens is, let's say there are two parties, A and B, and they are asked to put 25 rupees in both the two accounts. Right? So they posted the margin.
Yeah.
Day one, A made 5 rupees profit.
Yeah.
Which obviously means that B is going to make 5 rupees loss.
Yeah.
On the day one, then the account will hold 30 and this is 20.
Oh, okay.
क्या
Yeah.
डिफॉल्ट करोगे? क्या डिफॉल्ट करोगे? निकाल लो पूरा पैसा, कोई फर्क नहीं पड़ता, तो भी आज का प्रॉफिट हो गया, रियलाइज. Right? Why there is no default? Because now B will think Now B will think maybe next day I'll earn more. And A would think maybe I'll earn more. So nobody will. Achha, let's say, think about this. At the contract maturity, what if the price still remains the same? So at least we will get 20.
Yeah.
Right? But in case the loss is more than what he has put in the margin, he will get a margin call.
Oh, okay.
Right? And he will be asked to put in the money. And hence the one day profit or loss cannot be more than 25 or whatever he has in the account. He'll get a margin call immediately, or the transaction will be immediately being sold. The idea is that we can never ever be able to get away with making a huge loss and not making the payment.
Got it.
So how futures is different from forward is the concept of MTM, which is mark to market, because in futures the mark to market happens every single day.
Yeah.
While in forwards, since the contract will have the actual transaction will happen at the end, if one of the parties think that I am making a huge loss, he will not even show up. And anyways, there is no exchange of money at the initiation. Right? It's zero value at the initiation. So he has all the reasons to change his phone number and not pick up your phone.
Yeah.
Right? While in futures doesn't happen. So that's the same thing that we're trying to say here, that if the calculate the mark to market clearly means that you're doing an offsetting transaction. But I'm saying if whatever will happen, nothing will happen early. If everything is going to happen at the end of the contract, then what is the mark to market value as of today? Today, as in the spot, which is at day 30th. So all you need to do is you need to discount it back at 1.2%, adjust it for 60 days.
Yeah. Yeah.
Does it make sense?
Makes sense.
So we learned a lot of things in this question, where we first understood that how am I going to take an offsetting position? What offsetting position am I going to take? Secondly, that if I have to take offsetting position, then I would have to do some transaction in terms of what money I'm going to receive and what currency am I going to pay. And thirdly, whatever I'm going to pay, I will have to pay more. Had there been another question where he would buy the forward, let's say euro, right? In that case, he will have to sell it forward in terms of offsetting.
Yes.
Right? So he will be receiving AUD.
Yes.
So he would be receiving less of AUD.
Yes.
Right? And since originally he would anyways be buying the euro, right? So we would always be able to do the plus minus and calculate the profit or loss.
Yeah.
Okay. I'll also make you see one of the line that might make your life easier. Look at this. On the original trade, look at this. On the original trade, he was selling euro 10 million.
Yes.
So he will be buying, if he is selling euro, he will be receiving AUD.
Yes. Yes.
Okay. So on the offsetting, when he is buying euro, right, he will pay AUD.
Yes.
So can you also see that euro cancels out, and what he will have the net of AUD only.
Yep.
Right. So this also tells you something, that don't get confused, because some of the questions might give you options where it will give you receive AUD this much, pay euro this much, receive euro this much. So when you see a question which has an option of AUD, right, then by logic you would know that the option has to be in terms of AUD and not euro. Then calculation would not matter. Are you understanding what I'm saying?
Absolutely.
So jab questions ko, that's the reason when you really draw a timeline and when you know what am I paying and what am I receiving, so without even solving the question, you would know I am going to make money or make a loss. Basically, there will be profit or loss only in terms of AUD. So in the three options that you're going to get, the option that talks about euro, this much euro, that much euro, you can strike it off that this could not be the answer. Okay? And also one of the option will be 618800, while the question will ask you to calculate the mark to market. Okay? And one of the option will use rate of interest, which is 1.25.
Yeah.
Discounting will be done at 1.25 in one of the options, and one of the options is. Okay?
Yeah.
So that's the only way the CFA tricks you. If you know a few of these things, there's no way that you will be solving the question incorrectly.
Yeah. Thank you.
Okay. All right. The next topic that we have is, all right. The next thing is FX swap. You there, right?
Yep.
One interesting thing about FX swap is that this swap is not related to exchange in currencies. Not related to exchange. So you can say that is not effectively a swap at all. But the swap is being used little loosely in terms of that you are rolling over, or basically you are swapping from contract A to B. Hence the name FX swap. Right? So what does that mean? Let's say you have a 30 days contract. Right? And again, simple thing is you have 30 days contract of, let's say, buying USD, and you want to roll it over. So what you will do is 2 days prior to maturity, because these contracts get settled in 2 days, right? 2 days. So basically 30 days, you will go on 28th day, right? And you will sell USD. Sell USD spot. Why are you selling USD spot? Because this spot, whatever you will sell, it will also settle in 2 days.
Okay.
So effectively, what you're doing is, that when you have zero, 28, and this 30, so you have a 30 days contract of buying USD, which will get settled on 30th day, right?
Yeah.
You are selling USD spot, which will get settled in 2 days. So this is over.
Yeah.
And then you get another contract from here, 30 days by USD. So what did you do? You actually swapped your FX. So this is called as FX swap. But इसको तो settle करना पड़ेगा. ये तो आगे extend नहीं हो सकता ऐसे.
Which one?
The original one. This was the original one, right? It cannot be extended just like that. क्योंकि उसकी तो expiration date पे expire हो ही जाएगा. So क्या करना है उसको? We need to put an offsetting contract spot. Why spot? It will be settled in 2 days. And then you buy another contract for 30 days, and this will you keep on rolling over. Clear?
Yeah.
Let's look at this. A manager purchased 10 million ZAR 3 months forward at rate something, right? 2 days before contract expiration, the manager decides to extend the transaction for another 30 days. So what he should do is, since he's gonna purchase ZAR, 3 months and 2 days are left, then he should sell 10 million ZAR spot. When he's
Why
going
would
to
he
sell,
do?
go ahead. Ask me.
Why does he do spot?
Why does he do spot? Okay. He's going to receive ZAR, 10,000 ZAR in 2 days. But he doesn't need them.
Yeah.
What would he do?
Yeah.
His original contract is to buy.
Yeah.
Effectively, he will have to buy, right? Effectively, he will have to buy.
Yeah.
This is forward, right? So when I say sell forward, it means I will be selling in the future. Let me tell you this. 0, okay?
Yeah.
And this is 90 days. Let's look at what happens over here. When I say that I will buy 10 million USD, am I really buying? Buy 10 million USD forward 90 days. Am I really buying, or I'm just saying?
You're not really buying.
I'm not really buying, right?
Yeah.
So the whole idea of getting into forwards, futures, whatever, I'm interchangeably using the word forwards, future, because I'm not really considering margin for now. But the idea of getting on those contracts is that you are locking in the price today,
Correct.
but you are not really doing anything today.
Correct.
No transaction happens today.
Correct.
So when I say that I'll buy 10 million USD forward 9 days, it means that on this day I'm doing nothing, but I will effectively be buying 10 million USD on the 90th day. Now I'm saying it is 88th day. Now leave 88th day for now. I actually don't want to buy on 90 days. And I'm now thinking to buy on another 90 days, which is 180th day from today. But I'm approaching my 90th day, and I don't feel like buying now. I'm thinking to extend my contract for another 90 days.
Yeah.
But the problem is this has an obligation. There's an obligation for me to buy 10 million USD on the 90th day. What should I do?
You should sell. Yeah.
So I can't say, right? I cannot say that I don't want to buy. No, I have an obligation to buy, right? But what if I just sell 10 million USD spot? Again, do I really have to sell? But when I'm doing it on spot, spot basically means that I have done it today, that the transaction happens today, but effectively it will get settled in 2 days. It will be settled in 2 days. So on the second day, when I'll have an obligation to buy, right? I straight away sell. I have an obligation to sell and I have an obligation to buy. Cancels out.
I see.
Actually, कोई transaction करना ही नहीं है. Right? So while saying that I will buy 10 million USD in 90 days, on the 88th day, if I sell USD 10 million, which will get settled in 2 days, effectively this will just nullify and there's no transaction made whatsoever. Think about that. Now, what was my original ask? My original ask is that I wanted to buy 10 million USD for 90 days. So obviously I have to buy another contract.
Yeah.
10 million USD. And again, if I think that I still want to extend it, I'll do the same thing again after 88th day.
Correct.
So basically, I am just rolling over my contract. I'm just swapping my contracts.
Yeah.
Right? And without really executing it at the end.
Yeah.
Okay? Now look at this. And don't say, yeah, if you're not sure, just keep asking me, okay? I don't mind telling you again and again.
Yep.
Okay? Now look at this. The manager purchased, when he is using the word purchased 10 million ZAR, but effectively he just entered into the contract and he really didn't purchase it. ठीक है? ऐसे बस वो लिखने का तरीका है that he purchased, but the idea is that he get into the forward contract, which means that he will be buying. He hasn't bought it, but he will be buying 10 million ZAR at this rate.
Yep.
ठीक है? Now, 2 days before the contract expiration, the manager decides to extend the transaction for another 30 days. So what he'll do is, this is for 90 days. So on the 88th day, he will sell 10 million ZAR. Look at this. The manager sell spot 10 million ZAR to offset the maturing contract.
Right.
This will take care of my original contract. But obviously, he also says that he wants to extend the transaction for another 30 days. It means there has to be another contract that I want to get into.
Yep.
Look at this. Both the initial forward and the offsetting spot transaction will settle in 2 days. So this will take care of the original thing that we have done. Now, he can enter into a new 30-day forward contract to buy 10 million ZAR, whatever the rate would be. Is that clear?
Clear.
Yeah. When you will read this in your book, maybe, now that you have 4 days, not sure whether you will be carrying your book in Sri Lanka.
No, I am.
If you have carrying, just give it a glance and
Yeah.
you will realize that things are crystal clear. Okay? And still, if not, just come back.
Yep.
All right. The next thing to talk about is option basics. In option basics, I think something that we already covered a lot of time, where we think that in terms of call, which will give you the right to buy, and the delta moves from 0 to 1, right? And the put, which will give you the right to sell, and the delta moves from
0 to -1.
Okay. All right. I just want to quickly show you a table. I think we have covered it somewhere else, a lot of places. Just letting you know one more time. Okay. Achha, one thing that I want to again highlight is that whatever we talk about in terms of base currency.
Base currency. Yes.
Base currency. And this is the price currency. This is the base currency.
Yeah.
And before that, let me just quickly let's just do one more exercise. If I say that my INR by USD is, let's say, 85, right? And then I said INR by USD is, let's say, 80. Actually, it should be the other way around. Okay, but let's just look at the example, because I want to highlight something here. So which currency has appreciated and which currency has depreciated?
INR is appreciated, USD is depreciated.
Okay. USD has depreciated, right? This is initial and this is final.
Correct.
So I hope you know why am I saying that USD has depreciated, because the value has decreased and we look at with respect to base currency. Is that correct?
Yes.
The question is how much? So can I say that this is final by initial -1? If I really do this, then can I say this is 80 divided by 85? -1. ठीक है?
Yeah.
So is it right to say? Is it right to say that my USD has depreciated by 5.88%?
Yep.
USD has depreciated by 5.88%. And is it also right to say that INR has appreciated by 5.88%? Right?
Yeah. It should be. I don't know. It's a trick question.
Okay. So just remember this. This is not.
Yeah.
Okay. And why is that so? I'll also prove you mathematically, but theoretically also, if you're gonna get a question,
Because
you
your
have
base is different. Your base is different.
right. So this is what I was trying to make a point, that we always talk with respect to base currency, and we can clearly say that USD has depreciated, which is true, by how much? 5.88, 100% right.
Yeah.
Has INR appreciated?
No, no.
No,
It
no,
has
INR has
appreciated.
appreciated.
Yeah, but not.
There's no doubt about it, because the currencies are relative. If USD has appreciated, INR has indeed appreciated, but by how much? We need to do USD by INR as 1 by 85, and I would do USD by INR as 1 by 80. I have P here, I have Q here, and then I'm going to do Q by R, Q by P minus 1 into 100.
Right.
And I can show you very quickly that if I do 1 divided by 85, and if I do 1 divided by 80, and then if I do this divided by this minus 1, look at this. The INR has appreciated, but by 6.25%, while the USD depreciated by 5.88%. So they are not equal.
Yeah.
ठीक है, इसलिए the point is that no matter what we do, we would always be talking in terms of base currency. If the currencies are different, then we reverse the currencies and then we do the transaction. Again, we will only be talking with respect to the base currency. Yeah.
Clear.
Okay. Now, this last thing before we wrap up today's session is, look at this. As the price of the base currency increases, okay, again they're talking about with respect to base currency, the call option, again the put option, okay,
Yeah.
but it's again a simple thing. 0 to strike ja raha hai. 0 to strike, basically if it is a call option, it is going from 0 to 0.5.
Yeah.
The price is increasing and you have a call option. If the currency is increasing from 0 to strike price, from basically it is increasing, so you're going from 0 to 5, and from here it is going from -1 to -5, 0.5. Okay, why is it going from -1 to -5? Because you are selling the base currency. Right? Again, to the strike price, again it is 0.5 and -0.5, and more than the strike price,
Yes.
it goes from 0.5 to 1. It is the opposite. Something that we already know. It's just a repetition of what we already studied somewhere else.
Yeah.
Clear?
Clear.
Okay. So we will start with the home currency, etc. Okay. We will see if we'll be able to wrap up our currency session on Thursday. We'll be meeting on Thursday, right?
Yes, I will confirm to you. See, Thursday I have nothing basically. So definitely 7 a.m. to 9 a.m. I can do. I just have to check when I have to depart the hotel. That's all. So I will confirm to you on Tuesday. Is that okay?
Yeah. I mean, the only thing that you will be confirming is whether it's going to be Thursday or Friday, or will you be confirming if it is going to be Thursday and Wednesday?
Wednesday तो नहीं होगा. That is not possible.
Understood. So either Thursday को class होगी नहीं होगी, you will confirm me by Tuesday.
Yeah. You're
So
unable to do Friday. Friday you're busy.
No, I'm not. The days are scheduled on Friday.
There is something scheduled on Friday. Okay.
Not for me. I'm saying I will schedule a class for Friday.
Oh, you have something.
No. I have scheduled a class for you.
Got it. Clear.
So I'm saying if you are available, then let's just study Thursday, Friday, Saturday, Sunday.
Right. Right.
And let's just take a Monday off because you say you don't take classes on Monday usually.
Oh yeah, that's because I have a call in the mornings. That's why.
Which is fine. Which is fine. So I'm saying if you are available, then let's do Thursday, Friday, Saturday, Sunday.
Cool. Cool.
Right. And just in case you're not available on any of those days, then we'll try to shift.
Yeah. Perfect.
Okay. But I'm saying just do let me know for at least for Thursday by Tuesday.
That I will.
For Saturday, Sunday, maybe by Thursday.
Sure.
Okay. All right. Okay. Perfect. I hope you're understanding everything and things are good so far.
Yeah, I think maybe the 3-hour classes are a bit challenging because I don't know if the topic was tough or I just like dipped in concentration. But I definitely found this topic much more challenging than the one.
Which one? Today's session?
The currency part, not
okay.
Maybe I don't know what it is. Maybe it's the topic itself or it's the. I'm not.
Yeah, sure. Actually, no, Gaurav, you are right. Currencies are usually difficult, and they are. You think that you know it, but when you look at the question, you again think that you don't know it.
Got it.
Okay, it is very usual, and a lot of candidates tell me. But when they stick to the simple rules, they still try to make it. Okay. So maybe if you have a book and the topics that we have covered, maybe initially 3-4 topics we have covered, right? Just skim through the book and just focus on what I taught you. If you're able to solve the question, you're good to go. If not, we will talk about it.
Thanks.
Okay. All right. I'll see you on Thursday then.
Yeah.
All right. Thanks, Gaurav.